Law School. Please join me in giving a warm welcome to Brendan Milhorn. Brendan.
Thank you, John. As you mentioned, I'm an old national security lawyer. The last time I spoke to an American Bar Association committee was about a decade ago. We were talking cybersecurity and intelligence issues. So it's good to be back. One, thank you for having me back. But two, if it wasn't for that very kind introduction, I think I was at the wrong lunch. So for most of my professional life, I've worked to turn my perspective on law and policy into executable strategic plans. I like to say that for the first 24 years of my life, I was desperately trying to become an attorney, and for the rest of it, I tried not to practice at all. And then after a career in national security, I found myself at the FDIC 6 years ago, focusing on financial services, technology, and transformation. How could the agency overcome data silos, legacy technology, and rigid processes to more effectively supervise banks? How could we rethink our laws and policies and engagement with industry to foster innovation, reducing costs, improving compliance, and increasing access to financial services for underserved communities? Over the course of those 6 years, and with a brief hiatus on my part, the FDIC responded to a pandemic and managed several of the largest bank failures in the United States history. Failures accompanied by bank runs of extraordinary size and velocity. So after that financial services baptism by fire, I now find myself in a room full of banking lawyers, hoping to share my thoughts on the critical role of the dual banking system in maintaining a dynamic financial sector in the United States. As John mentioned, in December, I joined the Conference of State Bank Supervisors as president and CEO. Since 1902, CSBS has been the voice of the state supervisory system in Washington. Our members come from all 50 states, the District of Columbia, and the territories. They license and regulate the institutions, both bank and non-bank, that provide financial services vital to the national economy. Our members' supervisory activities have a uniquely local perspective. State supervisors understand the financial needs of the families and businesses that make up their communities. Our members are focused on consumer protection and safety and soundness, but they also work with their institutions to encourage economic growth and to mature the compliance framework for innovative products and services. Because of our local perspective, we do not always agree with our federal partners. But that tension and partnership is an integral part of the American economic experiment. Now, I will not start with Hamilton and Jefferson, and no one should expect a musical. But the states have been chartering banks since the early days of the Republic. Congress passed the National Bank Act in 1863, forming the foundation of the National Bank Charter that we know today. 50 years later, after a number of intervening financial crises, Congress established the Federal Reserve System. These two laws, the National Bank Act and the Federal Reserve Act, largely set the federal framework for the American dual banking system. This unique system has sustained the competitive, resilient, and vibrant financial services sector of the United States. We stand alone among nations in the number and diversity of our banks, ranging in size and business model from a small community bank serving one small community to some of the world's largest financial firms operating across the globe. This diversity is not an accident of history. It's the result of over 200 years of carefully considered and thoughtfully debated policy decisions. It's born from our founders' commitment to decentralized power and economic self-determination. These core values are reflected in our regulatory system, balancing national interests with local accountability. This truly American construct allows federal and state governments to focus on their strengths. It balances the stability of a strong national framework with the ability of states to provide for the well-being of their citizens and communities. Every time the dual banking system has been challenged, Congress has maintained a state-federal structure for financial oversight, rejecting a single monolithic approach that would produce myopia and uniformity. Congress has consistently recognized the dual banking system as a valuable contributor to safety and soundness, consumer protection, and competitive markets. In times of stress, however, Washington often forgets the historic success of this diverse and vibrant system. Driven by an instinct to control outcomes, federal regulators attempt to federalize and standardize. Unfortunately, in the wake of last year's high-profile failures, we are seeing the pendulum swing again toward one-size-fits-all federal regulatory uniformity. Our members are concerned with this trend. A federalized approach undermines the tremendous benefits of a financial services marketplace populated by banks of varying sizes and business models. While our banking laws are grounded in legitimate national interests and priorities, an overly restrictive implementation of those laws can hinder responsible growth, competition, and innovation. A Washington-centric regulatory approach can eliminate the extraordinary economic power of the dual banking system while providing no or only illusory benefits to financial stability, economic growth, or other national interests. The Basel III Endgame proposal is an unfortunate example of this bias federal regulators have toward standardization, and one that will have real-world consequences for credit availability and economic activity. Using an already opaque international standard as their starting point, the federal banking agencies have proposed to dramatically increase the United States regulatory capital requirements across most financial activities. Despite the mandate in federal law for tailoring regulation to the size, complexity, and risk profile of an institution, the proposal also would apply uniform capital requirements across an overly broad range of banks. The proposed rule offers little to no justification for many poor and exceedingly complex design choices. Take, for example, only one component, the capital treatment of loans to private companies. Under the proposal, these loans would face more punitive capital treatment compared to loans to publicly traded companies. There are many reasons that a firm may decide to stay private, and that decision in and of itself is not an indication of higher borrowing risk. Not only is there no factual justification for this requirement, but private, mid-sized companies are also important engines of local and regional economies. And regional banks, the very banks that would now be covered by lower thresholds in the proposal, happen to be critical lenders to these small and mid-sized companies. The proposal also increases risk weights far above the fundamental Basel Agreement for numerous products, again with little justification and with seeming disregard for the actual risk of the underlying activity or the economic consequences of the decision. If finalized, these decisions would have long-term negative impacts for United States financial markets, including a more consolidated and top-heavy banking system and reduced competition for certain products as banks reassess profitability. The capital rules are not the only areas where federal agencies are trying to regulate risk out of the banking system. We often hear frustration from our members over centralized decision-making from their federal counterparts. The vast majority of supervisory decisions should be made in the field, in cooperation with state regulators, not from behind a desk in Washington. Sending an issue up the chain to headquarters should be a rare exception, not a standard practice. This centralized decision-making has consequences for institutions and investors. I think everyone in this room would agree that application processing and approvals are at historic lows. Washington also appears particularly rigid with respect to diverse or unique business models. Lastly, state regulators know, and I'm sure many of you have experienced, that the rate of de novo approvals does not match the rate of qualified investor groups seeking a charter. Preemption also continues to unnecessarily threaten the vibrancy of the dual banking system. A few weeks ago, CSBS with the state mortgage regulators filed an amicus brief in Cantero v. Bank of America. In Cantero, the Supreme Court will address whether the National Bank Act preempts state laws requiring all banks operating in a state, including national banks, to pay a small amount of interest on residential mortgage escrow accounts. Now, we may disagree on the merits of requiring some modicum of interest on mortgage escrow accounts, but we should all be concerned about the federal overreach reflected in Quintero. The Supreme Court in Barnett and Congress in the Dodd-Frank Act clearly established the standard that the Office of the Comptroller of the Currency must apply to preempt state consumer protection laws. This preemption decision requires a case-by-case analysis, including supporting factual predicates and notice and comment. Instead, the OCC has avoided this issue for over a decade and pursued backdoor preemption by filing amicus briefs in support of national banks. If the OCC can avoid the clear requirements of the law, what stops its intrusion, or the intrusion of other banking agencies into other areas that are the clear province of the states? This federal encroachment now extends to the state's historic responsibility for corporate governance. The FDIC recently proposed, with no clear authority, guidelines that purport to strengthen corporate governance of state-chartered banks that are above $10 billion in assets or that are particularly complex, as determined by the FDIC. Far from best practices, these enforceable guidelines would micromanage how a bank's board functions, imposing a tangle of organizational requirements and procedural checklists. These guidelines would also interfere with the day-to-day operation of banks, confusing the role of management and the board. And perhaps the most egregious example of overreach, with no demonstrated basis and without regard to the diversity of state laws on the topic, the guidelines seemingly attempt to establish a new federal fiduciary obligation. Our members are concerned with this ill-advised proposal that it intrudes on over a century of precedent and carefully calibrated duties established in each state. Duties that reflect local perspectives regarding the appropriate scope of fiduciary responsibilities. The FDIC corporate governance proposal also relies on an exceedingly tenuous link to broad safety and soundness authority granted in Section 39 of the Federal Deposit Insurance Act. The Supreme Court considered this week arguments related to the breadth and continued vitality of Chevron deference. It's at least an open question whether the vague authorizations in Section 39 would support the FDIC's efforts to overturn long-standing state corporate governance rules. And if the court continues to apply the major question doctrine to cases with significant economic consequences, it seems unlikely that Section 39 contains sufficient congressional direction to overturn areas of law traditionally reserved to the states. There are many lessons to be learned from last year. Both state and federal regulators have taken a hard look at how we regulate and supervise banks, with a renewed focus on core financial risks. Unfortunately, in the swath of proposed federal regulations, guidelines, and supervisory actions over the last year, the relationship to the actual causes of the 2023 failures is not always clear. I'm concerned that we're making bankers prioritize everything, yet focus on nothing, drawing management and board attention away from core financial risk. The state-federal balance of the dual banking system is a feature, not a flaw. Federal regulators cannot alter this balance by fiat. Efforts to regulate away risk in banking are a fool's errand and can threaten the diversity that makes our banks resilient and encourages innovation. Now, while we do not always agree, I want to be clear. State regulators are committed to a robust and substantive state-federal partnership. The states charter 79% of the banks in this country, and for every one of those banks, we share supervisory responsibility with our federal partners. Our members work with their federal counterparts daily to keep our regulatory system strong and effective. We also look for ways to improve collaboration. In one example, we have proposed updates to the Bank Service Company Act so that federal regulators have clear authority to share information about banks' technology providers with appropriate state supervisors. Nearly all banks partner with third-party providers for functions ranging from core processing and lending to deposit taking and payments. This is especially true for smaller banks. The BSCA authorizes federal regulators to examine these service providers and assess the potential risks they pose to individual client banks and the broader banking system. 38 states have granted similar authority to their state regulators. Unfortunately, current law is silent on the ability of federal regulators to share vital information with state supervisors, resulting in duplicative and inefficient oversight of these service providers. The changes we have proposed would codify an important information sharing partnership in federal law. There's more than enough work to go around, and we are hopeful that Congress will pass this clarification and make it easier for regulators to protect banks and consumers. In Washington, leaders often bemoan a perceived lack of oversight of non-bank financial services. These arguments regularly accompany calls for additional federal oversight. Unfortunately, they also typically ignore the fact that states already provide a regulatory and supervisory framework for a large and diverse ecosystem of consumer-facing non-bank financial institutions. This non-bank regulatory system provides local accountability and operational flexibility as authorized by each state. But our members also recognize that many financial service providers operate beyond the borders of any one state. These institutions benefit from state-adopted common standards, even when they set the bar higher for consumer protection and safety and soundness. This consistency respects the prerogatives of individual states, reduces compliance costs, and ultimately increases the availability of responsible financial products. The establishment of the nationwide multi-state licensing system is one example of innovative efforts by the states to provide consistency to the non-bank financial services market. State regulators launched NMLS in 2008 to license and register mortgage lenders and companies, and Congress mandated the system's use in the SAFE Act. NMLS brought a new level of professionalism to the mortgage industry, and the system continues to be a strong source of consumer protection. Beyond mortgages, NMLS also serves as the platform for licensing debt, consumer finance, and money service businesses. More than 556,000 individuals and nearly 34,000 companies are licensed and supervised through NMLS. Millions of consumers visit NMLS each year to verify the licensing status of a financial service company or a professional. The system also provides a mechanism for state regulators to track and manage consumer complaints. NMLS helped transform state non-bank regulation and supervision, and our members are developing other mechanisms to provide shared standards and practices for non-banks. Take payments, for example. Working with our members and industry, CSBS helped develop the Money Transmission Modernization Act, which increases standards and capital requirements for covered firms. 14 states have adopted the standards in the past 2 years, and 8 states have introduced the bill so far in 2024. The law not only gives certainty to money transmitters, but also to their partners in the financial system. When a bank partners with a state-supervised money transmitter, the MTMA's high standards allow the bank to conduct more focused due diligence around safety and soundness, consumer protection, and anti-money laundering compliance. States also approved standards for non-bank mortgage servicers in 2021. With these companies serving more and more consumers, states are focused on setting clear expectations on financial condition and corporate governance. So far, 6 states have adopted these prudential standards. Given the multi-state operation of most mortgage firms, these 6 states effectively cover 98% of the non-bank market by loan count and include 50 of the largest non-bank mortgage servicers. Our members will expand this coverage as they work with their legislatures or consider other mechanisms to adopt these common sense requirements. As you can see, states not only license and supervise a wide range of non-bank financial institutions, but they are also constantly searching for new ways to improve that supervision. As with nearly all industries, technology has been a driver of change for the financial services sector. Although the core supervisory mission of our members has remained the same, technology has transformed how we execute that mission. NMLS, for example, is not just a licensing system. The platform is also a mechanism for executing our networked supervision concept, where non-bank financial institutions operating in more than one state have a single, consolidated, and streamlined exam to support each state's supervision. To advance our efforts to improve supervision, our members have identified 3 core objectives to build a modern, technology-driven state supervisory system. First, we are reimagining supervision so that our understanding of the health of individual institutions and the entire ecosystem can evolve as rapidly as the sector itself. When our supervision can't keep pace with advances in technology, supervisors become an anchor on innovation across the entire financial system. Relying on point-in-time exams to supervise the financial system moving at the speed of technology is not a sustainable model. Supervisors need to work with financial institutions to visualize changes over time at each institution and across the entire ecosystem. This continuous engagement model, supported by advances in supervisory technology, can help identify risks that threaten institutions, consumers, or broader financial stability before they occur. Second, as financial institutions adopt new technology and develop innovative products and services, supervisors must work with them to mature compliance frameworks. As regulators, it is easy to say no, to stand confidently behind the plate and stridently call balls and strikes. This mentality, however, does little to guide institutions concerning how their compliance must evolve to incorporate new technologies. And regulation by enforcement or litigation or one-off supervisory actions spreads uncertainty across the entire ecosystem, increasing compliance costs for institutions that are trying to innovate, discouraging new institutions from making the effort, and forcing technology development outside the regulatory perimeter. State regulators are working with their institutions to mature this regulatory environment. A great example of this public-private partnership can be found in our efforts to promote effective defense against cyber threats. Working with the Bankers Electronic Crimes Task Force and the United States Secret Service, our members released ransomware self-assessment tools for both banks and non-banks in 2020. RSET helps financial institutions assess how they can mitigate ransomware risks and identify other cybersecurity gaps. We recently updated RSAT for banks based on real-life lessons learned and insights from cybersecurity experts and financial institutions. This tools rather than rules approach is a hallmark of state regulators' role as both institution supervisor and industry partner. Finally, an innovative and responsive supervision system will only be successful if it is supported by a talented and empowered workforce. Like every employer in every industry, state regulatory agencies are challenged with hiring and retaining a skilled workforce. To address these challenges, we must rethink how we train our examiners, how we augment our commissioned workforce with subject matter experts, and how we equip our supervisors with new technologies to visualize and mitigate risks. Across the nation, our members remain vigilant to protect consumers and to promote innovation and economic growth in their states. And even when we disagree, we will continue to support engagement and collaboration with our federal partners. After all, this tension and this partnership is so vital to the American experience. It has made our diverse economy the envy of the world.